Trevelyan Next is a division of Trevelyan, a financial services specialist search and talent advisory firm. Since inception, the Trevelyan team has dedicated itself to enhancing the return on investment of a company's most important resource, its people.
Hello, everyone. I'm Brian Love, head of Trevelyan's banking and fintech practice. Since 1998, Trevelyan has helped financial institutions all over the country with their most important talent mandates, including executive search, succession planning, and advisory projects with boards and leadership teams. Please visit TrevelyanGroup.com to learn more about us, our history, and the clients we've assisted. Our firm also created our content channel, Trevelyan Next, in 2020 to be a differentiated voice in the financial services industry. And today's webinar is the embodiment of this ideal. So here's the setup. We've brought back Mike Bell, partner at law firm Honigman LLP. Mike, how are you?
Good, Brian. Really excited to be here today, sincerely.
Well, you bet. Great to invite you back. Mike was just a few weeks ago joined by Jeff Cardone, partner at Luce Gorman, to discuss the emerging trend of credit unions buying community banks. And when we posted the webinar to social media, it was shared widely and was one of our more viral pieces of content, which is always great when you go viral. Brad Bolton, past chair of the ICBA, Independent Community Bankers of America, and also president and CEO of Community Spirit Bank in Alabama, left some comments on our LinkedIn post that welcomed us to having a sequel or a follow-up conversation with a new perspective involved, the ICBAs. So now Mike and Brad have, I believe, appeared in articles on this subject, but I do believe that this is the first time they're appearing together on a screen or a stage. Mm-hmm. So thanks to both of you for being here today, and I really look forward to a lively discussion. So Brad, you're no stranger to Trevelyan Next, having appeared in a few segments over the years with us. Thank you for that. Yeah. And thanks for being here today. So tell us a little bit more about yourself and what the ICBA represents, as well as what your effort is around this issue.
Brian, I appreciate you allowing me to join Michael with this important discussion. I am Brad Bolton. I'm a past chairman of ICBA, and ICBA is certainly focused on one mission, and that's creating and promoting an environment where community banks flourish. Because we know that where community banks flourish, communities have an opportunity to flourish. And we've got evidence of that because community banks are the lifeblood of Main Street. We represent the only banking presence in 1/3 of all U.S. counties. We make 60% of all small business loans and 80% of all the ag loans. And specifically on this topic of credit unions buying tax-paying community banks, we think it's an important topic to present that we as community bankers, we support local, state, and national efforts through about $12 billion a year in taxes paid annually. And I'm very passionate about protecting the community bank franchise so that all communities have an opportunity to be successful. And we saw from the pandemic that community banks rose to the challenge better than anyone in the financial services sector, making sure that Main Street America was protected. And so I want to protect community banks to have that opportunity to be able to be successful for the next decade, for the next 2 decades, for the next century. My bank's 116 years old, and I'm just so passionate about what community bankers do every day, and I want to protect those franchises. So I appreciate this dialogue and allowing us to come and be able to give our side of the story.
Perfect. Thank you, Brad. Credit union and bank M&A. That's the subject matter of this webinar. There have been, I believe, roughly 80 of these deals announced since 2015. And really, there's no signs of it slowing. There's 4 that were announced already this year, I believe, maybe more than that, in a rather slow M&A climate. Brad, your home state of Alabama has had several credit union bank deals announced over the years as well. So before we dive into some of these, hot topics, I just wanted to get, Brad, a little bit about what factors you see driving some of your constituents to M&A.
Well, in my personal opinion, I think that M&A is directly tied to over-regulation of our industry. I think we've all on this call seen that we've lost a lot of community bank franchises over our careers. I've been at the bank 28 years this month, and I know that the number of community bank franchises has shrank from, I don't know, somewhere around 15,000 down to 4,000 or so during that time. And I think it's a direct correlation that as community bank franchises have decreased, the regulatory burden has increased substantially. And that is one big issue that I think drives mergers and acquisitions. People in rural America, people in urban America that are running community banks are just so frustrated by the regulatory overreach that we have to deal with each and every day. Obviously, Michael mentioned in his session last time about succession. I do think that's an issue, and that's one thing that I've been trying to promote as I went across the country, promoting the importance of community banks rising up that next generation of leaders, or I call them community continuators, to lead community banks for the future. So those are the two big drivers, in my opinion, on M&A.
So that's overregulation and succession issues.
Mm-hmm. Yep.
And I think that fits, well with what Mike and Jeff discussed a few weeks back. Mike, I think it was you. I'm kind of quoting you as saying that there's plenty more of these types of deals on the way where credit unions are going to be acquiring banks. Each of us have talked about the suitors for community banks if they were to be acquired. Mm-hmm. There's investor groups, there's, fintechs, although that's very few and far between. There's other community banks, of course, that's the most common, even MOEs that probably will happen. But isn't a credit union a better suitor than most and potentially less disruptive than others? Mike, I'll let you start that question.
Yeah, Brian, first I want to say, I agree with Brad's comments. The overregulation piece is a problem. And I use the word like community financial institution. And I'm not being cute. I have so much respect for community banks and credit unions because they are community-based financial institutions. And then I would parrot everything Brad said about community-based financial institutions. They truly are the backbone. And I kind of view, and I don't want to say enemies, right? It's not like it's adversarial necessarily, but I view, money center, large banks, and then all these non-banks. I open up my newspaper here in Florida, and all these hot CD rates are not at a community bank or credit union. They're at a non-bank. I view those as our biggest threat, right? Those are the ones putting pressure on community institutions, and our regulators then aren't helping us. They're piling it on. And so fast forward, Brian, to your question. In my experience, when a community-based institution goes to sell, it feels like today there's really only a couple options. Like you said, a great majority of the transactions are going to be like kind or community bank to community bank, which is lovely and wonderful. And then there's this amorphous investor group idea out there that, good or bad, I think they've gotten a bad rap. And I think the regulators have taken an unfair position and kind of labeled every investor group as bad, regardless of the merits. And so that really hurts the seller, kind of takes them off the table. And the other option is another community-based financial institution, a credit union. And I think there's one other factor I want to mention that I think is unfair for community banks today. And that is, and I'm not an expert on stock prices, right? I limit myself, but I can tell you that it seems to me that bank stocks have been unfairly impaired, right? There's many bank stocks out there that I think are impaired because of the industry at large, unfair to the actual institution and their merits, which then affects them as being able to be a buyer. And I think that's completely unfair. But I think it can take, and I'd ask Brad for his thoughts on this, but I think it takes certain buyers out of the buy line so that a seller is even more limited today, which, is not a good thing in my opinion.
Brad, did you want to respond?
Yeah, well, back to the question of is credit unions a better suitor? I think my response. I would disagree with that. And I've heard the argument from even some regulators and some industry advocates for consolidations that if we don't allow credit unions to buy a community bank, then there will be no other folks who would be available for them. But I'm just passionate about the fact that it doesn't have an asset size. It doesn't matter where you locate a community bank. You can be successful. And I do think that some of this comes down to old and antiquated M&A rules. At present, if you've got a community bank that's operating in a similar market from another community bank who wants to sell, they're up against antitrust rules because of the HHI index. And you can look that up and see that it's an old and antiquated rule that really doesn't even count the credit union deposits that are inside of that market. So that's one problem that we've got some strong community bank acquisition folks who would like to buy other community banks, but they're limited because of old and antiquated rules. So that's one thing the ICBA is doing, is working with regulators to try to update those M&A rules to at least include credit union deposits, because they do exist. We had one down in Southeast Alabama where the credit union deposits were over $2 billion, but they acted as if they didn't exist, and it kept two community banks from merging together for at least 36 months before they got their deal done over antitrust. So that's something that we've got to update those M&A rules.
Yeah, and Brian, I'm just going to say, and it's not going to be this the entire time, but I completely agree with Brad, right? I would scream from the mountaintop that HHI and what that does to community banks is completely backwards, completely incorrect, and is unfair to all in the industry, honestly. Deposits are deposits. Community-based deposits are community-based deposits, in my opinion, whether it's at a bank or a credit union, and it's messy. And Brad, anytime I look at that HHI, my head starts to spin. And, I'm reasonably educated. It's absurd what they ask you to do, without question.
And Michael makes the important point of community financial institutions. That is important, whether it's who we are as community bankers. That's just in our DNA. But I do think that whenever you're talking about a credit union in Michigan buying a community bank in Florida, is that really local ties? Is that truly local people continue to make local decisions? And I would argue that is not the case. Here in Alabama, I'm home-owned and home-owned, and we make decisions locally. And I think whenever you see deals like that, especially out-of-state acquisitions, it just screams that is completely outside of the credit union mission. So again, that should be a part of M&A rules being updated to at least take a look at that. That's why we're asking Congress to hold hearings to see, is credit unions still inside their box? Because we would argue they are not. They have left their mission and mandate years ago. They were never intended to buy our community banks, and that's what we're advocating for.
Well, yeah, and let me just jump in. We'll hammer this home, the geographical piece.
Yeah.
As Brad mentioned, and we talked about it on the previous webinar, there's been a swath of upper Midwestern credit unions that have acquired Southeastern-based community banks. And from whatever perspective you look at it, it does seem slightly foreign, although it's clear to see that there's snowbirds that may share both geographies. But Mike, I think you've been behind several of those deals. Why don't you respond with your best interpretation or thoughts on this matter?
I'd be happy to. And Brian, just for the record, all but one of those deals. Let's just make that clear.
There we go.
Yeah. So look, I think, on the surface, again, Brad makes a good point. I respect what he's saying. I understand how you can look at it and think, what in the world? How does that feel to membership? Now, I'll tell you, we got to peel back a layer, and I'm exhibit A to that layer. Okay. I'm a member of Lake Michigan Credit Union. I was born and raised in Michigan. I was a member of Lake Michigan Credit Union. I lived in West Michigan. I live in Sarasota, Florida. I've helped Lake Michigan buy two banks on the west coast of Florida. And if you look, prior to them buying those banks, they had thousands and thousands and thousands of members up and down the west coast of Florida, just like me. That's part of the story. That doesn't solve the story. That doesn't, refute everything Brad said. But I want to just remind people that it's not lip service or it's not a maybe. I can tell you in all these transactions, there are thousands and thousands of members that are kind of being followed, right? And I'll support that with the fact that when I drive around Sarasota, I drive right by a Liberty Bank branch. They're based in Ohio, right? I drive right by Fifth Third branches. Fifth Third now is kind of mega, right, Brad? But at the time, I think Fifth Third was in Cincinnati and they're building branches in Florida. This is not a foreign idea. It's just new in the credit union space. And I only say that because let's not forget, in the credit union space, there might be about 5,000, but there's only a couple hundred with any sort of scale or size. So we're talking about like the very minimal of the minimal in the industry. But in addition to kind of having the existing members, the fact that you happen to have a headquarters somewhere and you have business somewhere else, I don't think in and of itself stops field of membership. There are credit unions across the country that have FOM that might be in disparate states like Michigan to Nevada to North Carolina, but they serve a limited community in a limited way through a certain FOM connected to underserved communities and employers and such. I know it's a sensitive topic, but I think the details support, in my opinion, it's not rampant flaunting of the rules, running rabid growth if you really look. But respected on the surface, it could seem other.
And I respect that opinion, Michael. But I do look at the actual charter, the mission and mandate that created credit unions in 1933 to serve people of a common bond and of modest means. Now, the credit union that bought the bank in Michigan specializes in airplane lending. I don't know what part of common bond or modest means fits into that category. And I agree with you in terms of it is these large growth obsessive credit unions that seem to be getting all of the press. They're the ones that are really out there aggressive. If it's a mom and pop credit union that is still just serving one industry and they're staying in their lane and their box of what their mission was, we don't have a problem with those. It's those that are crossing those state lines and still get to keep their tax exemption status. You know, the savings and loan industry started not acting like a savings and loan back in the 50s. They got their tax exemption taken away because of that. And so that's why we think that all of these issues build up that Congress should hold hearings on this, that to see if credit unions truly are serving that mission that justifies that tax exemption. And I'm sure that Brian will talk about pricing in a little bit, but to us as community bankers, it just screams unequal and unlevel playing field. You know, Fifth Third, they're a big bank, but they pay taxes. And so if these credit unions are going to act like a bank and call themselves a bank, they should be treated equally, regulated through CRA, and pay their taxes.
Yeah, and so Brian, I just one follow-up, but first I want to say this. You started a trend. Brad, I love talking with you and about this, and I think we need to do this again or do it somewhere else. Like I do this anytime. And here's a great example. So on the airplane lending thing, Brad, that was my reaction. When I was involved in this transaction, which that was one of my transactions, I thought, what in the world is this, right? Well, peel back the layer, and you know what this is. This is the most credit union-y thing I've ever seen in my life. There's two different associations across America that support these hobbyists that buy real small planes or build planes or buy planes with like multiple buddies or people. And this bank down in Florida had a couple staff members that like set up a table at these events and would offer loans to these folks to buy small planes or hobby planes. And I started to look deeper into these associations, and that was like credit union, like heartbeat. And so it's not Boeing 737s. This is actually super credit union-y airplane lending that I think Brad, if you had the ability to look at it, you'd be like, whoa, this is interesting. These are small dollar loans that happen to involve hobbyists. It's really cool. Now, on the surface, it sounds wild, but when you peel it back, it's really a neat thing, in my opinion.
Well, let's move on here. I feel like Lester Holt.
No, Brian, Brad and I are just gonna keep talking. Yeah.
Well, one thought I did have, though, I'm a community banker. I grew up in community banking, and we always targeted the banks. It was always in the market. You're trying to get the loans of your competitors, et cetera. It seems like it's an opportunity, Brad, when you see a Michigan credit union go down to Florida. Those banks in Florida could say, hey, that's open season to try and go after that bank's customers and loans. I don't know. It's always about competitive advantage. And we always thought when banks' credit decisions were being made 5-10 states away, it never made sense for your client right there. It's quicker decisions, et cetera. Anyway, we don't need to belabor that. Maybe that part is cut out anyway. But let's talk about, by the way, you guys have agreed on two things so far. So let's just, there's the agreement counter is HHI and overregulation. So we're good. There's some agreements here. Talking about geography, states taking some stances right now. So there are states that are actually implementing laws to prohibit these deals. Two being Mississippi, Brad, right next to you, and Tennessee, a little further north from you. Others have made it very difficult. Minnesota, Iowa, I think Illinois. there's something out there right now and we'll talk a little bit later about that, about an exit fee that they're trying to impose. I mean, I'm just kind of curious, Mike, tell us about what you've been involved in these conversations. And then Brad, I'd love your response as well.
Yeah, and just to set the stage, based on my involvement and what I know, there's never been a question about a credit union's right to buy. Any kind of legislation we've seen to date has been to prevent a community bank from selling or to take away the power a community bank has to sell. I believe that's what happened in Mississippi, and that's what's going to happen in Tennessee. They're going to pass laws saying to the bank, you don't have a right to sell to a credit union. Look, this is happening across the country. I think I've testified in 6 or 7 state legislatures over the last 2 years on this very effort of these very bills. My response is these transactions are voluntary. There's no such thing as a hostile takeover. Nobody can make anybody do anything. And that I feel like a bank should have a choice on who they want to sell to. And I often say that I think it's important to let the free market be free. Brad would respond, I believe that, Mike, it's actually not free. You guys have a tax advantage and it's subsidized. And let's talk about that in a minute, right? But in this instance, I'll tell you, Brian, that I think this is just simply about, can a bank choose to sell to who they want to or not with this legislation? And I'm on the side of letting them choose. Love to hear what Brad has to say about it.
Well, obviously, I'm on the opposite end of the spectrum on this because I applaud those states that have implemented some rules and some laws to limit these deals from taking place, because I believe it's incumbent upon local legislatures, state banking departments, and state banking associations, frankly, to take an active role in this, because we should be for community banks, not community bank sellers. I'm a free market guy. I love that people have the opportunity to choose what they want to do with their franchises, but it does come at a cost to local communities, to our state communities. And obviously in my state, I'm a state chartered bank. So as the number of state charters shrinks, somebody's still got to pay to keep the state banking department going. So the community banks who are left, our assessment fees are going to go up. That's something that we have to think about. So, credit unions, whenever they buy a community bank, they don't have to obtain approval to close offices. They're not subject to CRA, and I'm sure we'll talk about that a little bit. And sometimes whenever they pay goodwill for deposits, that goodwill becomes fictitious Tier 1 capital. So, that's something that I think the state legislatures cannot ignore. Whenever a credit union here funds a mortgage, they pay no mortgage tax. So our counties lose mortgage tax revenue that I'm having to pay. And so it's just an unequal and unlevel playing field. And I think that's why state legislatures are actually paying attention to this and saying, you know what, we don't want to look here 20 years from now and we have no community banks left. And we've got all these credit unions who paying no taxes. Their executives don't publish what they make personally. The only not-for-profit in the nation that doesn't have to do that. And so it's rightfully so that Mississippi said, listen, if you want to sell your bank, that's cool. It needs to go to another FDIC or OCC or Federal Reserve insured institution, just so we can protect the tax base and the local economies that we are to represent as a state legislature.
So the tax exempt status is probably the biggest piece of this. Mike, you've mentioned it a couple of times. Brad, you just brought it up. That's a major crux of the disagreement here, right? And I got to be honest, as an outsider looking in, if a non-tax-paying company acquires a tax-paying company, the tax revenue is gone. I mean, tell me if I'm wrong, Mike, because I think you represent the other side of this. How can that revenue ever be recouped by those local and state governments?
Yeah, so no, it's a fair point. Again, I think your feeling there, Brad, is accurate. Or Brian, and then Brad's point, wherever I'm at, that tax issue looms large, right? That word's coming out of the mouth of everybody everywhere. I would say let's take a quick look, though, at the playing field. I would tell you that if you look close, I can't give you the exact number, but I think half of the banks that were purchased by credit unions were S-Corp banks. S-Corp banks don't pay a bank level tax, right? To be clear, C Corp banks do, but S Corp banks do not. So I think just simply saying, just at large, these deals are going to take away tax revenue, I think is not accurate. And then I would tell you, if you look close at a lot of community-based institutions that are C Corps, and you look at the amount of tax being paid, it's actually exceptionally low. So before we kind of rush to judgment and just say that these deals make tax dollars disappear, I think we need to look close first to see, number one, are they being paid? How much is being paid? Because then let's have a fair discussion. And then second, I will tell you, the IRS, as we all know, is not stupid, right? So there are specific IRS provisions that get triggered in certain instances. I'll give you an example. Every time we do a transaction in Florida and we merge in a bank into a credit union, a specific IRS code provision gets triggered. When a nonprofit acquires a for-profit, it requires a tax to be paid. Hundreds of millions of dollars. That's right, hundreds of millions of dollars in tax have been paid based on the Florida transactions we've done that have triggered that provision, as they should be. I'm not arguing with Brad about that. That makes sense. When certain factors are right, IRS has rules about when taxes get paid. Credit unions aren't exempt from that piece. So I like to go, again, just slightly deeper, recognizing the fair point and saying, what are we really talking about before we just start to kind of label things unfair or inappropriate? And I think that we will find it's less offensive. I think Brad would agree, depending on the state you're in, depending on federal or state chartered, credit unions do pay taxes. They pay different types of taxes. They may not pay a federal income tax, but they'll pay state and local taxes depending on where they are, property taxes, et cetera, et cetera. So simply saying they're untaxed is not accurate. And then we have to look deeper at what they're buying.
Well, I am an S Corp, and I can attest to the fact that my tax equivalent distributions that go to our shareholders are taxed at a higher level than what the C Corp is. C Corp's at 21%. We're sending up nearly 39% to our shareholders for them to pay taxes on. So taxes are being paid by S Corp banks, as you know. So I think that's an important distinction there. And I would look at those numbers, and I have. I look deep into the numbers that I think there's been 44 deals announced in the last 40 months by my rude
I'll trust you. I don't keep count, Brad, but I trust you.
Oh, yes, you do, Mike. You do keep count.
and so I look up the UBPRs of these community banks that's been acquired. And I've stopped counting at $50 million in taxes that those banks paid. That's annually. And that's state and federal taxes. That's gone forever. And that point cannot be overstated enough. If you extrapolate that after deal after deal after deal, and some of the credit union lobbyists and their friends want to say that they're buying unprofitable banks or, in this case, S Corp banks. But it doesn't really matter to me. I just look up the UBPR and I see that, hey, there's $50 million lost revenue that's going to get worse and worse and worse. We heard the president at the State of the Union talk about corporations paying their fair share and how they can ignore the credit union industry with $2 trillion in assets. It's just truly unbelievable to me. And whenever you're buying a taxpaying community bank, it just screams mission creep. Let's look at this. Let's really see this for what it is. And it's padding the pockets of credit union executives. They should be accountable to their members, just like I'm accountable to my board and my shareholders, but it doesn't feel like that they are.
Yeah, and I appreciate that. And I'll explain that, I think if you look across our country, there are cooperatives or nonprofits in every industry, whether it's hospitals, agriculture, energy, you name it, that are the size of trillions of dollars, right? And don't pay taxes. And so I think our legislators determined, right, we have a dual system, a triple system, a quadruple system, you name it, that when there's multiple different types of institutions, that's a good thing by and large. And I am not quick to get lost in maybe siloing out a statistic. I think we need to, again, look at our entire industries and understand that this happens, and it happens for a reason. But then second, I'll tell you, and we'll talk about it later, I guess, the salary thing or this idea that it's about enriching. I'm pleased to address, my perspective on that. as well when the time is right.
Yeah, well, let's stay on the tax piece for a little bit longer. Brad, in those comments that you fired away when the last video was posted, you stated that only 21% of the general public are aware that credit unions have a tax exemption, while 78% say it is important their financial institution be fully regulated. Is that statement about the public desiring their banking institutions having regulation related to deposits and insurance? I was just kind of curious if you could tell me a little bit more about that statement, and then I'd love to hear your response, Mike.
Yeah, I definitely think it's twofold. ICBA conducted some research with the Morning Consult just to get consumers' take on where things stand on a lot of issues, and credit unions was one of them. And it was not surprising to us, but I think it is surprising to some that the public doesn't know that credit unions doesn't pay any taxes. And if you sit down with a consumer and you explain to them that what if you operated your business and you had a competitor in the same town, y'all sold the same widgets every day, but yet your competitor got to sell theirs cheaper because they didn't have to pay taxes. Well, anyone would look at that and say, well, that's not fair. I would not like that at all. Well, that's what we compete against credit unions every day. And that's the frustrating thing for us. And I think whenever you explain that to the public, they are concerned about that. The second part of that is I do think that consumers, especially since the large and risky bank failures of 2023, it put the words liquidity and is my money safe at the forefront. And I think consumers want to know that their bank is highly regulated, that someone is looking out for their best interests, and they want to know that their money is safe. And so as an FDIC insured institution, they have confidence in knowing that someone is looking over our shoulders. And community banks have our shoulders really looked over much more than the credit union industry. I think sometimes NCUA is more of a cheerleader regulator than a regulator. That's for probably a broader topic and discussion. But, whenever I see a credit union like up in Indiana that had private deposit insurance buying a community bank, immediately I ask questions of, what is this? Does the depositors of that bank know that they're coming into an institution that will be private insurance? Because this past year showed the importance that deposit insurance exists, that it's paid for by banks, and it's regulated by the federal government. So those are issues I think consumers are definitely paying attention to.
Mike?
Yeah, so I can't, speak to those statistics specifically, right? I looked at them and I understand, what they're being used to suggest, and I didn't, but I know that the credit union lobbies have the same statistics that say something different, right? But I do appreciate Brad's point about safety and soundness, and that definitely is on the tip of all of our tongues and consumers' tongues ever since 2023. And those, I believe, by the way, that was an oddity. Those banks are different. They weren't community banks and they weren't credit unions, the ones that failed. And I do think that's put a highlight on community-based financial institutions in a good way. So my phone started ringing after that, and I started to talk to a lot of professionals, not necessarily consumers, but professionals in the banking space, saying, Mike, wait, what do you think about credit unions with what happened to SVB and this kind of thing? And we took a deep dive and we looked at not just credit unions, but community banks too, and how safe we are due to the diversity of our customer base, right? So Brad, I don't know a thing about your bank, but I know that you have all kinds of customers from all kinds of walks of life. I promise, right? That's the same thing credit unions have, and that is so different than those banks that failed. And one of the reasons they failed is because all their customers were all the same, and they all Twittered each other, and they all moved their deposits or whatever. So I think community financial institutions came out of this looking, correctly so, as a safer option. I will say, in my opinion, I think the NCUA is an appropriate and an aggressive regulator. And if you talk to all the bank lawyers that do these transactions with me, the guys from Luce, from Fenimore, from Reinhardt, there's just some regular bank lawyer players, they would tell you that the NCUA is quite surgical, quite difficult to work with, and very hands-on in these transactions, such that it's almost offensive to the sensibilities. So I'm not their cheerleader as a regulator, nor am I the FDIC's cheerleader. I'm just a third party that interacts with them. But I'll tell you that it's robust and it's not child's play. We have to earn it every time. And let me just give you an example. The first minute I file anything, I could file a dissertation on how the field of membership works, right? Because it's a question. We live with those rules. We can't escape them. Doesn't matter. The first thing they're going to do is beat up field of membership in a forensic way to make sure that it actually works and all the rules are being followed before they even look at the packet. It's like a gatekeeping scenario that most people don't understand occurs, but it occurs intensely, down to the member, down to the customer. So depending on our scenario, we will literally take every bank customer, zip codes, where they work, where they go to church. We'll make, we got to figure it all out. And to a person, make sure they fit within the FOM or there's an FOM answer before the transaction moves forward. It's very detailed. It's not flippant, and it's not child's play. If you ask me, it's too detailed, but that's just me as an outsider. I think it's a little unfair. It's a little HHI, Brad, in my opinion.
Well, if I could just follow up one thing on that, Brian, I do think that consumers should know all the risk and rewards of any transaction, and it should be forthright of that. And when it comes to not only safety and soundness, but just the overall regulatory environment of going from being a community bank customer to a credit union customer, the NCUA's own chief regulator, he's been concerned about the cybersecurity risk, and we may talk about that a little bit. That credit unions are just not held to the same standard as what banks are. They don't have the third-party oversight. Credit union agency is begging for more power so that they can monitor the third-party oversights of credit unions. And I think it puts consumers who become a customer of a credit union more at risk from a cybersecurity perspective. Not to mention the CRA issues of consumer financial protections. That I think they are better protected in the confines of a community bank than they are whenever they move over to a credit union, because they just really have no standards in that regard.
Well, yeah, and Brad, I appreciate you bringing up the cybersecurity. We'll talk about that in a minute. Just 30 seconds, because just doing some research. The exit fee idea, is that a concession that has legs from both of your perspectives, or is that just hogwash?
It's definitely something that we're advocating for, and it helps offset that loss of tax revenue that I mentioned earlier, of those 44 or so banks that have been acquired. You're never getting that tax revenue back again. So the least we can do is to help level that playing field of what price is being paid by the credit union for the community bank, to help level that up, because I'm convinced that there are some community bank acquirers out there that would like to have those community bank sellers. But whenever a credit union is able to look at tax, the line item before tax instead of the line item after tax, whenever they decide how much they're going to pay for a deal, it makes for an unequal and unlevel playing field, in my opinion. And so to level that up, I do think an exit fee is a great solution to at least level the playing field so that community banks are treated equally whenever we're entertaining the opportunity to buy a branch or an institution as a whole.
Yeah, and I'll tell you, it's I think it's a terrible idea. I think it's overregulation. I think it's manipulation of a market that is currently free and voluntary, and I think it's a mistake. I think that the second we start talking about or surgically inserting things of that nature, it's going to hit us all. There's going to be fees for all sorts of things. It just doesn't make sense. So I respectfully disagree and think it's a terrible idea. And when the time is right, I'd be pleased to talk about pricing and how it works. And I'll tell you, dissuade the fallacy that credit unions can overpay and have some advantage in pricing. I respectfully don't believe that's true, and I'm happy to talk about it.
Well, it's a little bit off script, but you've both mentioned pricing. So, Mike, on that point, let's talk about it. That's the stigma out there is, even credit, I got to be honest, even credit unions out there putting commercial loans on the street, and I talk to lenders and they say, we can't compete with these credit union rates. They're different. They're able to do things differently. this is a situation too where it seems like the credit unions may have, an upper hand with what they can spend as opposed to what a bank can. Let's just talk about that for a second. Go ahead, Mike.
Yeah, so first, let me just kind of set the stage anecdotally, right? So the first ever transaction actually that I did was like in 2011, right? So since 2011, let's say, have there been 80 of these? Let's just agree on 80 or 70. It doesn't matter, but let's just say there's been 80. We see the press release for the successful ones. What no one has seen is the over 1,000 times we have not been the winning bidder. Right? I was testifying a year or two ago in Iowa, and I said, it's perception. You can say, hey, there's been 55 of these, and that's too many. I said, well, what you didn't see were the other 900 times we tried and we lost to a community bank bidder. So first, let me make that point, that it's incorrect to assume if a credit union's involved, they just waltz in, roll the dollars out, and nobody competes. We lose 7, 8 out of 10 times. And we win 2 to 3 times, okay, based on my experience, number one. Number two, today, when we talk about pricing, I will tell you that there's a scientific way to value a bank. None of us are bank valuation experts, but I think we all realize there's bank valuation tools. I've never been involved in a transaction where we have overpaid or paid in excess of what we believe to be a scientific value of the bank. But I think depending upon market cycles, banks can be at a disadvantage. And I'll tell you, I think it's happening right now. So right now, a credit union only has one form of currency, and that's cash. They can't give stock, right? So if we say we're going to pay you X, you're getting X. Cash is worth what cash is worth. Now that helps us and hurts us depending on what a seller wants and where we are in cycles. But that's just the only card we can play. When a bank goes to buy a bank, they might use some cash, they might not, but they're going to use their stock. And I mentioned it earlier, unfair to community banks today. I think their stock is impaired, whether they deserve it or not. And so today, when they're trying to buy, I assume we could come in at a same or similar market-based price. But a question is arising, wait, well, what's that stock really worth? What's really the price? What's our risk? That's not fair to Brad. That's not fair to his competitors necessarily that their stock is impaired, but that's not in our control. It has nothing to do with credit unions. It's just a fact of the matter. So this perception that a credit union overpays, I think, is completely incorrect. It's just their currency, depending on where we are in the cycle, could be more valuable or more sought after, in my opinion. And that might skew it. But I promise, even now, even today, even this year when there's been, I think, 7 transactions announced, and Brad hasn't said it yet, but I think 27% of the deals announced to date have been a credit union buying a bank. I'll say it. We've lost more times than we've won. Period. Already this year, I have lost more bids than we've won, even in this year that looks so dramatically up.
Brad, do you have a response or thoughts?
Yeah, I mean, I think that it just still, to me, screams the unequal and unlevel playing field. You just described how stocks are, manipulated, downtrodden, whatever, based on where we are. And whenever you've got an institution such as a credit union that's buying a bank, I don't see the accountability. And that's the biggest thing that I scream. If they are a nonprofit, then that is being aided by the taxpayer, shouldn't those deals be made public? The terms of those deals be made public. I never see them out there. So, I think it's a fair point that if you're going to have a tax subsidy, every acquisition that happens, it grows the taxpayer subsidized segment of the financial services industry. And so I think that credit union executives should have to publish their salaries through a 990 like every other not-for-profit in this nation. And I think the terms of these deals should be made public. And that way you can prove me wrong out here as a naysayer of why I think these deals are wrong and they are subsidized by taxpayers. Lay it out there and say, hey, we are a tax exempt entity. We are a tax exempt entity, and here's the terms of the deal. And so we'll know. Did you pay high? Did you pay low? Because in my experience, the ones that I have heard about of community bank acquirers wanting to buy some institutions, they came back and said, hey, our bid wasn't even in the market from what the credit union paid. Now, maybe that's regional, maybe that's just down here where that some credit unions are doing some odd things, but you can't ignore it. They're paying more, or they wouldn't be getting the deals.
Well,
So, Brian, go ahead.
Yeah, go ahead. No,
I was just going to say, so Brad, I agree with one thing that Brad said, and I think he's spot on. But here's what's so interesting about it, Brad. I can speak to the clients I represent. I don't do every transaction. I think I do most of them, but not every one. We're not keeping pricing secret. It's not up to us. It's the selling bank. So if a bank is publicly traded, it's disclosed. If a bank is not, it's up to the bank if it's going to be disclosed or not the buyer. I'll tell you, the buyer, we don't care. And I'm not in a flippant way, but we're very open book to our membership, our member owners. You can see what we paid. If you look at our annual report, you look at our call reports, you can figure it out real quick by doing a little math. It's not a secret, but it's not ours to share. The selling bank has to share that. And I'm a big fan of them sharing it because I think it would clear up some of this confusion. I respect that anecdotally, Brad, you have heard from people like, man, we didn't pay anywhere near that. I think that's true. I don't think those people are liars. I could tell you the same anecdotal things when we see transactions announced and we were like, boy, we would have never paid what that bank just paid. Same conversations, and I think both sides are telling the truth. But I think pricing should be public. And Brad, I think you and I ought to get on the stage and say that to everybody. I'd hold hands with you and we could say, disclose your pricing. I think it's a good idea. I agree.
If we get Congress to hold some hearings on this, we can let them decide. And I think we could make a good case of it that, hey, regardless if the selling community bank wants to publish it or not, as long as the taxpayer is on the hook here and the taxpayer is subsidizing these credit unions, it should be made public.
And the first thing we have to do when we have that hearing, though, is to say to those people, first, leave us alone. Let us run our institution. Don't overregulate us. Oh, and by the way, let's disclose price. I think it's got to be a two-pronged discussion.
Well, I'm almost, going to cry for all the agreements that we're having. I was expecting WrestleMania. It's like kumbaya. Anyway, not too much time left here, but there are three subjects that we talked about that I would hopefully just get maybe quick responses from each of you about. Brad, you mentioned cybersecurity, and I don't know how the NCUA scrutinizes cybersecurity. I have some idea, more so on the community bank side. Is that a truth? Are customers taking on more risk in cybersecurity? Since Brad brought that up, let's let Mike respond first, and then Brad, if you want to put a bow on it.
Yeah, so it's a fair point. I think cybersecurity is a huge issue for community financial institutions because we don't have the budgets that Bank of America has, right, or that Chase Bank has. So it's a big deal. I'll tell you, I believe it's one of the issues specifically identified by the NCUA, along with like liquidity as an example, that they're focused on this year and that they're driving home to institutions upon examination. So I'm not aware of this perceived under-regulation in that regard or under-care in that regard. All the things apply to us that apply to banks in that regard based upon the seat I sit in. And it's a big deal and it's important. One thing that helps is scale. I know it doesn't sound great. People hate the idea of growth for growth's sake or scale just for scale's sake. But I do think with scale, you take some risk out of the system and can do a little bit better job of cybersecurity.
Well, I'll just take Chairman Todd Harper's own words, and he indicated that he feels like that since they don't have the power, the NCUA doesn't have the power to regulate third-party providers for credit unions, that it's a, quote, regulatory blind spot. And that means that the agency doesn't necessarily know what is truly happening inside of these credit unions, and it leaves them with what he referred to as a soft underbelly of the broader financial system, that it truly opens up more risk to the financial services industry in general because the NCUA doesn't have the same powers as the FDIC, the OCC, and the Federal Reserve to come into a credit union and look one step further into those third-party suppliers. And at the end of the day, because they don't have that, it's a great unknown of what's going on out there. And I think it puts credit union customers at great risk and peril for, risks that they don't even know exist. So if the NCUA chairman's concerned about it, I think it should concern all of us. And again, Congress needs to give NCUA the power to regulate them just like they do us. And that's all we ask for, is to treat us all equally and the same. When it comes to cybersecurity, CRA, whatever, if you're serving consumers, we should all be held to the same regulatory scrutiny as a community bank. And that's just truly not what's happening in the credit union space.
Well, and I would think Mike probably agrees with some of that. Everyone should be held to a similar standard in the FI space, right?
Yeah, I do agree. And I think, and Brad's right. I mean, Chairman Harper said that. I think, though, that you've got to look. I think it was a multi-page letter, and I think that politics could be at play, with all due respect to everybody, and a regulator's trying to get some more power to do some extra regulation, and raises an issue such as that in a dramatic way to try to grab it. It reminds me of every time we hear the guy from the CFPB speak, Brad. He's got these tales of woe, and he's trying to grab more power and tell us how we should run our business. So I think it's incorrect to assume there's a cybersecurity problem. I think you've got to view it in context as someone who made a statement trying to get a little bit more power to be able to perhaps overregulate, which is something I don't care for and that nobody cares for. And it's regulated today. I just think you got to have a little context there.
Could be, and I'm not for overregulation.
Right.
But at the end of the day, they are treated differently than us, yet they're providing the same service that we do. And that just can't be ignored here in this whole discussion. This whole topic is the unequal and unlevel playing field. You're tired of hearing me say it, but it does exist.
No, and Brad, I don't disagree. And I think the way to fix it, to the extent it exists, is for you all to be able to lose some of that regulation, right? Because it's unnecessary. That's the fight I want to fight. I'm being sincere. Like some of the things, CRA, no offense. I like the idea. I think it's a terrible burden. I think that, Brad, your bank is going to bank the community whether CRA exists or not. And you always have and you always will. And I would say that for every community bank I've seen. Yep. That's what every credit union does. I'll be honest. They bank the community regardless of CRA applying or not. It shouldn't be there. Rather than say everybody needs CRA, I think we need to stand together and say nobody needs CRA. Nobody needs HHI, right? That's the truth of the matter. Because, Brad, you don't need CRA. It's not fair to you, period.
Well, I agree. I'm going to serve my community regardless of regulation, and every community bank that I know does the same, but it does create that regulatory burden that we have to endure. And, HMDA banks are one step further, that they have to endure that. But, on the CRA front in general, because it does exist and because we do have to endure the regulation, again, it puts more staff that we have to put on to manage that credit unions simply don't. Yet they're providing the same level of service to our customers as what we are, but without the regulatory burden. And it's just, it's not right. It's unfair. And I hope that out of the CRA modernization that they would hold credit unions accountable to come in and at least, if they're not going to remove it from us, put them to the same regulatory scrutiny as what I'm having to endure every day.
Okay. Well, on that note, and thank you for bringing CRA up. That was a topic I wanted to address. And it seems like we need to have a third one of these and have a regulator on with us. That might be the way to go. And it may be an NCUA and an FDIC or whatever it may be. Nonetheless, I think we're out of time. I cannot thank you both enough. This was really a highlight for me to have a point and a counterpoint. You guys were very well behaved. WrestleMania is in Philly in a few weeks, I think. So, we can maybe have another round there. But no, thank you so much, Mike Bell. I appreciate it. Brad Bolton, very much appreciate you being here.
Pleasure, Brian. Thank you.
Yeah, been a pleasure. Michael, I appreciate the back and forth, and I'm sure we will continue this on social media in some respect going forward. And, appreciate the dialogue and being able to share our perspective on this important issue.
Yeah, it's the same. Brad, I have so much respect for your advocacy. You live and die it, and I respect that so much. And think I agree with you more than I don't, because we know what's important in communities. And so I wish we could keep the dialogue going. And I appreciate, Brian, you getting it started anyways. This is good stuff.
Well, by the way, I did count 6 agreements, at least.
Yeah.
So we're going to have a little counter.
What I heard the most of is Michael wants to level the playing field and hold credit unions to the same standard as we have. That's all I could ask for.
Yeah. Tax them. That's what I said. We should tax them.
All right. Well, thank you so much. And I wish you both the best in your future endeavors.
Thanks,
Brian. Thank you.